Welcome to the Winthrop Wealth second quarter 2021 market review and outlook. I'm Andrew Murphy, Co-Chief Investment Officer. In today's video, I'll discuss inflation and interest rates, take a look at the U.S. bond and equity markets, and provide context for our outlook and portfolio positioning as we move forward. Please visit our website at winthropwealth.com to view the full written version. From everyone here at Winthrop Wealth, we hope that you have a great summer. As always, please let us know if you have any questions, and we look forward to speaking with you soon. Let's start with inflation, as we have received a lot of questions about this topic lately. This is a chart of the Fed's preferred measure of inflation, the Core Personal Consumption Expenditures Index, or Core PCE. And Core just means that the reading excludes food and energy prices. So while you may have noticed prices going up at the grocery store or at the gas station, that is not reflected here. The latest Core PCE reading for May increased by 3.4% year over year, the highest level since 1992. And while the Fed has admitted that recent inflation data has been higher than expected, they still believe the latest increases are transitory or temporary. The latest FOMC summary of economic projections has inflation ending the year around 3%, before declining and leveling out to around 2% by 2022. In other words, the Fed believes that inflation has peaked. We are also in the transitory camp due to the Fed's influence and the deflationary forces of technological innovation, aging demographics, and globalization. And while we believe that inflation readings are likely to decelerate in the latter half of the year, we are still hedging by holding little cash in portfolios, avoiding long-term bonds, and overweighting the equities of companies that are able to grow their cash flows, earnings, and dividends. And please see our client question on inflation that details how the data is calculated, why the Fed cares about and targets inflation, and the impact it has on various asset classes, including cash, fixed income, and equities. Now we'll take a look at interest rates. One of the biggest surprises of the quarter was the decrease in the 10-year Treasury yield. After reaching an all-time low of 0.51% in August of 2020, the 10-year yield increased to 1.74% at the end of the first quarter before declining to its present level of 1.47%. Long-term interest rates are typically mainly driven by estimates of economic growth and inflation. And the drop in the 10-year was partially due to the decreasing odds of major fiscal stimulus bills passing and the market coming around to the idea that inflation may have peaked. But we won't read too much into the decline in rates this quarter, as we believe the most likely scenario is for the 10-year Treasury yield to eventually drift higher while inflation moves back toward 2%. If we look at a chart that shows the Bloomberg Barclays U.S. Aggregate Bond Index, which acts as a proxy for the investment-grade bond market in blue, and the 10-year yield in gray, you can see that interest rates and bond prices move inversely to each other. The second quarter was a reversal of the first quarter, as this time the decrease in yields pushed the Ag Index higher by 1.8%. Now we'll move over to the U.S. equity market. The S&P 500 increased by 8.6% in the second quarter and ended the period at a new all-time high. After increasing by 6.2% in the first quarter, the market is now higher by 15.2% for the year. If we go back a little bit further, after declining by nearly 34% during the pandemic sell-off from February 19th to March 23rd last year, the S&P 500 is up by over 96% from the low. The overall market continues to be driven by 5 pillars: progress on the vaccine rollout, accommodative monetary policy, fiscal stimulus, strong corporate earnings growth, and the reopening of the economy. Last, we'll finish with our outlook. While recent performance has been impressive, the financial markets will now begin to transition as we have likely reached peak levels of corporate earnings growth, economic growth, fiscal stimulus, and monetary stimulus. While the absolute levels will remain high, the growth rates will begin to decelerate as we move further away from the pandemic and the economy transitions into more of a mid-cycle environment. In contrast to last year, the stock market will face headwinds caused by the economic recovery, including higher interest rates and inflation, the possibility that the Fed may tighten earlier than expected, and the potential for higher taxes. We still observe signs of froth and investor complacency as the market has essentially moved higher in a straight line over the past 15 months. Of course, history shows us that stocks do not move in a straight line forever, and volatility is inevitable. Our portfolio positioning has remained consistent over the last several months as we continue through the year with a measured approach, and we continue to trim equities and lock in gains while the stock market has rallied to new highs. On the equity side, we remain tilted toward high-quality U.S. stocks. On the fixed income side, we continue to focus on achieving balanced stability and income while accounting for short-term cash needs. As always, we will continue to apply our time-tested investment process based on risk management, asset allocation, and security selection as we monitor new developments and utilize any volatility as an opportunity to reposition portfolios. Thank you for watching today's video. Please visit our website at winthropwealth.com to view our latest commentaries.